presentation on something else.
Um,
So great to be here, and thank you. This is Advanced Wealth and Tax Strategies, and I've got maybe in the future we talk even more in depth on taxes. So we're just going to kick it off and get going. So standard disclaimer, this is for educational purposes only. I'm going to oversimplify some complex tax concepts just to get the comprehension through. I don't want to get talking Iras tax code because that's going to put you to sleep, and it's going to make me even wake up even more, and that's not going to be good for anybody. There are nuances and rule changes to each and every one of these things. So this is about launching your passive wealth business and leaving taxes behind. And so as part of this, my quick story is I started at Deloitte & Touche in San Francisco. It's a big four CPA firm. Along the way, I served as director of acquisitions for hedge fund, bought 875 houses for them. I had a CPA firm focused on high net worth real estate investors. My former clients up through the time I sold in 2016. If anybody knows any gurus in the Dallas area, they were likely a client of mine or somebody I worked with in some capacity. I worked with all the big guys. It was fun. I enjoyed it, but I could never get away with it, away from being a CPA. So I'd go on vacation, and ultimately I'd have to come back and always help somebody with their 7 to 11-figure transaction. So enough about that. I've also got a background doing active and passive investments in hotels, apartments. I was a millionaire in my 20s, retired at 32 to travel the world. Now I have a company, Financial Journey, which serves as a wealth connector and helps people set up their own family office. So all that to say, and you guys can't even see my screen, so I'm going to just keep sharing and go from there. So what would you do if you didn't have to work? What's your current monthly passive income? What's the gap? What's your current monthly gap? What would you do? What would it take to fill that gap? So your passive income's at $5,000 a month and you need $20,000 a month to retire and not have to work again. How do we fill that gap? And so we're going to talk a little bit about just wealth in brief, and then we're going to dive in more into the tax strategy and give you guys real value. So how close are you to work optional now? So if the goal is freedom, let's get an understanding of how big that gap is and what do we have to do to incrementally bridge that gap. That's what I help clients do. There's a couple of key concepts that are part of this. And first and foremost, your wealth is the business. And so are you so busy making money that you miss the opportunity to become wealthy? There's a lot of people that get caught up in just doing their work, doing their business. They don't really think about why they're doing it. And if you think of wealth as your primary business, this goal reorients your thinking to become CEO of your wealth business. And it starts having you think about how much time is spent on building assets versus generating income. So here's the organizational chart where your work, your investments, your finances, lifestyle, giving, etc., all fits down within this. This is not to say that wealth is the most important goal, but it is simply this orientation that recognizes the orientation of each of the divisions of your wealth business within that. And it's simply wealth that fuels your vision, that it gives you the money. The money itself isn't the goal. It's what allows you to go further faster. Concentration versus diversification. Concentrate enough to thrive, diversify enough to survive. So when somebody concentrates and they get really good at a single asset class like multifamily apartments, that allows them to evaluate deals, and they get really good at finding great deals within a single asset class and allows them to go further faster. But to an extent, in any asset class, it's good to be diversified enough so that if a single asset class were to go bad, you've got lots of other investments to help you bounce back. So along with that, I love for clients to focus on what I call double dip assets. These are investments that have equity and cash flow. So I'm looking for assets that allow you to make money in a couple ways. And I'll talk a little bit more about that. So if you have assets that just provide cash flow, they'll pay for your lifestyle costs to lower your risk, but they're also taxed at a higher tax bracket. Versus if you focus on equity growth investments, they're going to allow you to build wealth, avoid inflation loss, and they're taxed at lower capital gains rates. When you get double dip assets, you get the best of both, helps you towards work optional, more cash flow, more equity. And then within that, a few examples of what these assets might represent. Cash flowing assets, your bonds, if you're a hard money lender, many service-based business, it's cash flow. The moment you leave it, you stop working, your business goes away. But if you're, or equity growth, it's non-dividend paying stocks or land or your personal house. A lot of startup businesses, there's not really any cash flow from that. And that's why I like people to focus on double dip assets, especially when they're just getting started. And that can be dividend paying stocks, rental houses, or apartments, because you've got both equity and cash flow from it. It's a great way to go further faster, and you make money both ways, and there's a bunch of benefits as a result. And so as part of this, how's your deal flow? Are you finding great deals on a regular basis? Do you have great deal sources like the Apartment Queen? Is your deal flow a trickle? Is it steady? Is it a flood? I like to show people how to find great deals. And so I think you're already in a good spot. You've got a great deal source where you're at now. And then also consider, depending on the asset class, where else might you find deals? There's money managers like financial advisors who are going to take their fees. There's syndicators out there. Work with people that you know, have learned, you've got some history with. You can ask your network. One of my favorite things to do is whenever I get into a deal, you do a deal with the Apartment Queen, next time they throw an event, ask all the passive investors, where do they find their best deals? And when everybody's working together and talking about where they're getting their best deals from, that's where the best players really rise to the surface. When you hear the same name over and over again as a great source, that's how you know that's somebody you should check out. And then professionals, are there certain people that serve your industry, your certain and desired investment class? So if it's multifamily apartments, maybe you go into accountants or lenders or other vendors like construction workers. Guys, who do they like to work with? Who do they think is the best in the industry? Trade shows, when I was doing hotels, I like to actively and passively invest. So I go to a big convention, and then the guy who's winning all the awards, maybe invest with them, or ask all the vendors who they would invest with if they've been around for a while. A mastermind group, there are all sorts of connections with regular people that are like-minded that can help you understand where the best investments are and how to vet those deals. There's also investment clubs like Iras, incubators, angel networks, all catered around your chosen investment class. It's important to keep your money working. If you earn a 20% return on your investment, but then you exit that investment, say in September of this year, and then the last 3 months of the year, your money sits idle. If you've got a 20% IRR while you're in that investment, and then it sits idle for 3 months, now your 20% return now drops to 15%. So I love to have a plan 2 to 3 months. If I know an apartment selling off a couple months from now, I want to get an estimate of what I'm going to get in terms of a distribution and have a plan to put that into place again. So if Kaylee is one of my favorite syndicators, I'm going to be looking for emails ahead of time, looking at what deal she might have, so I can put my money to use with her. Again, the moment I exit, I'm able to put it back in to another great deal. Investment vehicles. There's your personal name. You can invest in your personal name, or I'll say an LLC. This is really from a legal and tax efficiency that I'm going to discuss investment vehicles. There's your IRA, your 401k, infinite banking. This is debt leveraged life insurance. I'm going to talk a little bit more about each in just a second. So there's your self-directed account. And the point is that you can use your IRA, your 401k to invest in just about anything, from real estate, investing with Kaylee, there's private lending, there's cryptocurrency, private businesses, and there's all the traditional stuff you can do like stocks and bonds. But the point is you can have full control of your investments if you want to. And some people really get into this where they've got their 401k accounts, their spouse has a 401k account, maybe they do an HSA, a health savings account, a CISA, Coverdale Education Savings Account for their kids, and they really want to invest collectively. Well, sometimes you can only put a few $1,000s in an account per year due to whatever limitation, but most syndicators are going to look for a $25,000 to $100,000 investment minimum. And so as a result, you can combine all those together. And so what I'm suggesting here is you aggregate all those accounts and they become partners in an LLC, so you can really take down some of these bigger investments. So if you need $50,000 to invest, maybe a traditional retirement account doesn't have that much money on your own, but if you're combining multiple family members together, you likely don't mind doing the due diligence for your family and picking a great investment to go in. Then you can combine your funds, and so you can invest in a larger deal like something with Kaylee. There's your personal name. So investing in your personal name typically will bring maximum simplicity, liability. LLCs, I will just say short thing on LLCs. It can be a disregarded entity, meaning you don't have to file a separate tax return, which could be your Schedule C for a small business or Schedule E for rental property. There's a partnership tax return. That's a great way to get stuff off your personal tax return and lower your audit risk. Well, S corps are used more if you've got self-employment tax, and you can put a ceiling on how much self-employment tax you're going to pay, but not so great for real estate. C corps are often used in more specialized situation, like a software startup, a rollover business startup, a company that's completely owned and operated by your retirement account or benefit corporation. I could go in depth on each and every one of these for an hour, but I'm not going to kill you with that right now. So retirement accounts. I like 401ks so much more than IRAs. And I'm going to talk to something that a lot of sponsors either can't talk to because they're supposed to not be offering educational advice, or they're simply unaware. And if you've got a chance to do a 401k, always do that over an IRA, in my humble opinion. The reason why is, one, through a mega Roth IRA, you can Google that term and you'll see how you can put $58,000 a year into a 401k, and that can be per spouse. And there are ways where I've seen where people have multiple companies, different control groups, a little more technical, but they can, where they can put in $58,000 for each different company or control group. And so there's been instances where people are putting in $500,000 a year into a traditional 401k. It gets really extreme what's possible with a good amount of planning. In a 401k, if you do an investment and you make a mistake, it's a prohibited transaction, then you get a 15% penalty on the amount you invested. So if you invest $100,000, prohibited transaction, $15,000 penalty on $100,000. Nobody likes it. It's like a ticket. It's a slap on the wrist. You lose $15,000, you move on. If you do that same investment, prohibited transaction in IRA, and you do a prohibited transaction, your entire IRA blows up. So if you have $1 million IRA and you only have $100,000 investment in there, the entire IRA gets distributed. You're going to lose about 90% of your IRA to taxes and penalties by the time you're done. That's really terrible. So also 401k, there's no unrelated debt financed income on investments. Let's say you were to use an IRA and invest with Kaylee. It's nothing that Kaylee's doing, but the IRS is going to say, hey, if Kaylee buys a $1 million apartment complex and there's a $700,000 mortgage, that ratio of $700,000 to $1 million is 70%. Now, 70% of your income as an IRA investor would be subject to UBIT, or more specifically, unrelated debt financed income, and you'd have to pay taxes at the 37% tax bracket once your income exceeds 13%. It's terrible. Don't do it, because you can do a 401k instead, and there's no UDFI. You skip having to file the 990T tax returns, and there's all sorts of headaches you get to avoid as a result. So short, to sum it all up, 401ks are way better than IRAs. Sometimes I get people are like, I don't want the government telling me when I can retire, so I'm not going to use retirement accounts. For me, I had that attitude for a while. I've gotten to the point where my personal wealth is enough for me to live off of. So now I'm going for more tax efficiency. And I know that I can get to a point where there's something called substantially equal periodic payments, or also known as a 72T distribution. I could, if I'm 25 or 20, it doesn't matter my age, if I've got a big enough balance in my retirement account, I can retire at any point and start taking my money penalty free, as long as I can continue those distributions through age 60 or 55, depending on the type of account I have, and not have to pay any penalties. So there are ways. I think retirement accounts are often overlooked by people who like alternative investments like real estate, because of they don't like the government involvement and the hassle. Infinite banking. This one recently came to my attention. I looked at infinite banking probably 5-10 years ago, and I thought the fees drastically outweighed the benefit. Often took a decade or more to just break even on the fees. And so what this is it's overfunded whole life insurance. And I actually like indexed universal life insurance. And the way it works is, let's say you're going to take out $1 million policy. You're going to pay in $100,000 a year. It can be really whatever amount you want, but you can do $100,000 a year for 10 years. But along the way, you can withdraw 95% of the balance and use it for alternative investing. So your money can grow. You can choose the index under Universal Life, the S&P 500, or several other indexes, whatever you think is going to do most favorable. You can change your index each year. And so as a result, your investments often grow at 6 to 9% in traditional investments. And then with that growth, you're able to take a loan out against it and then go invest that money again in real estate. And that's how you've got the same balance of money is invested in both the traditional investments, and then because of your loan against it, you're investing again. You've got two pots that are kind of growing based on the same initial cash that you had put in. And so it can be really significant, the growth that comes with it. So as a result, if we're comparing different investment vehicles, Roth, especially I like Roth accounts, preferably 401k, that's going to grow the most. If you're doing infinite banking, that's a great follow-up investment. I like after the Roth, after you've maxed out your Roth. And then there's your personal account. This is based on me. I'm 36, so I ran these numbers based on real infinite banking numbers, based on Roth accounts. I projected these out to kind of give people an idea of what the wealth can compound depending on which investment vehicles you use. So let's match the vehicle to the asset. So this presentation is geared towards passive investors and the stuff that you can control. And so one of the things you can control is which investment vehicle you invest in. So if you're doing ordinary income type investments, so these are this is going to be better for a 401k, IRA, HSA. So anything like your real estate, your flips, your loans, your cryptocurrency, frequent trades, things that are generating ordinary income, or you've got capital gains and tax deductions. These are going to be better for your personal name. If you've got a business, you want those tax deductions to flow to you. If you've got real estate like longer term holds, rentals, you want those tax deductions like depreciation to flow through to you. Oil and gas has great deductions, cryptocurrency, or stocks that should say a year or more hold time. That's where you want it to be more likely in your personal name so that you're able to benefit from some of the more favorable tax treatment. As a general rule of thumb, don't let the tax tail wag the dog. People can get so caught up in the tax planning and as part of this that they miss the opportunity to invest or something like that. Always only spend money for a tax deduction when it actually makes business sense. So 401k tax strategies. I want to discuss some ways to quickly grow wealth in a Roth 401k. So you can supercharge your contributions through after-tax contributions to a Roth 401k. So most people have heard of the $19,500 they can put in as an employee pre-tax to a traditional 401k. And then your employer could put another $6,000 in. So you're often around 27,000-ish in deductions. But with the additional $32,000 of after-tax contributions, that's the part most people miss. And you can set up your own plan and do this. And so what do you need to have a solo 401k? Your company, if you work in a W-2 job, you can have a solo 401k plan through them. But if you start your own company, even if you're just earning $1 of income, it needs to be a legitimate business, but that could be selling stuff out of your garage, an eBay business, a sewing business, something that was previously a hobby, you turn it into a legitimate small business. Now suddenly you can roll a bunch of money in from your other IRAs, from 401ks, typically when you leave a company or a past employer, you can roll that in, and now you've got your own 401k entity to invest through. And so this is how, if you're doing $58,000 a year per spouse, per company, per control group, how much money do you want to put in? You can really max this out. But this is where this really gets juicy. And I'm really excited for you guys to be a part of this. So strategic rollovers. So what this is doing, let's say you've got $100,000 and you invest it with Kaylee. And she, as part of this, has done her homework and knows, hey, this is apartment complex my investors are investing in is a heavy rehab. I'm going to have to take it from 80% occupancy down to 60% occupancy, bump out some tenants that aren't paying. I'm also going to be doing a major rehab. And because of that, the occupancy is going to drop temporarily. And so I buy the apartment day one, and Kaylee starts kicking people out. 6 months in, she's like, hey, this is as bad as it's going to get. We're 6 months in, our net operating income has dropped to the lowest. So maybe our net operating income dropped in half because we took the occupancy from 80% to 60%. So because the NOI is in half, my investment is temporarily worth half of its value. So I invested $100,000, and because the investment's worth half, now I'm going to roll over the investment, not the cash, from a traditional account to a Roth account. So if I had just rolled $100,000 cash to a Roth account, I'd pay taxes on the $100,000. If I'm at the 37% tax bracket, that means $37,000 goes to the government, and I lose out on that. If I'm in California, I'm losing 50% likely. But with the strategic rollover, you're only limiting your taxes to 37% of $50,000. If we've got time, I'll walk through an example of something what I did recently that's going to end up with a 15 to 20% discount, or let me say that differently, an 85 to 80% discount. So I'm only paying taxes on 15 to 20% of what I put into the property. And so this is how you can get a lot of money from a traditional account to a Roth account legally with a little bit of planning. Is that exciting? I hope so.
Yes.
There's other ways to get discounts. So there's control discounts. If you put $100,000 with Kaylee and day two rolls around, you no longer have control of that money. So you can also get a discount. So if generally, if you had a preference, money is worth more in your pocket than somebody else, even if they're just borrowing it for an investment. That's how you can knock another maybe 10 to 15% off. So over time, the Roth can compound. Doing this through a Roth account means your wealth can grow 2 to 5 times, depending on how much time you have before you start taking it. The IRS doesn't take a bite of your apple each year, and you're never paying taxes on it again. So in theory, I'll use big round numbers. Maybe through my Mega Roth 401k, I'm putting in $100,000 into my traditional account this year. And then a few weeks later, I do a rollover from my traditional to my Roth account at $50,000. So I'm getting $100,000 tax deduction for putting money into a traditional account. I'm doing a $50,000 rollover, so I'm going to pay taxes on 50, but I'm still ahead $50,000 in terms of my net tax deduction. The $100,000 tax deduction, $50,000 in taxes, they net out, and I'm still ahead. And that's why I like the Roth conversion. So there's a lot of things that we could talk more. I'd love to open it up to questions, see what resonates with you, ask any other tax questions you might have or how this might work, and then I'm happy to connect further in time.
That was awesome. Thank you so much for presenting some really great things that I think a lot of people, including myself before meeting you, didn't know were a possibility when it comes to investing. And it's not, I think, the traditional set of knowledge that we're given when we're in, like you said, these groups, et cetera. So one thing that you mentioned to me that stuck out to me, and everybody that is listening right now, you have the opportunity in the Q&A to ask any questions, and I'll look for those. Or if you want, you can stick them in the chat, and we'll answer those as well. But I'll start off with one. So when we mentioned earlier about being able to take the valuation of your shares or your investment in a property that may be at a lower occupancy and is in these deals that we do, and it does get devalued, how would you phrase that to someone as that's not scary? So for example, if you're in year one and we're taking occupancy down, your shares or your valuation, fair market valuation. So for example, when you have invested with like a Roth or an IRA, the custodian's usually asking for the fair market valuation of the investor's shares. And, if they go, okay, I invested $100,000 and right now it's worth like 45 or something like that, I tend to get emails where people are freaking out. Can we explain to someone who's in that situation, sending me that email, not to freak out and what that means? That's good, I guess.
I think it's important to understand the investment process. When you are doing a deal, you're often buying something distressed or like you, Kaylee, you're adding value at some point. And part of that is often you doing a major rehab or kicking out tenants, but simply to work on a project, if you've got to have people gone to go work on the apartment complex, that's part of the process. And so the income will drop temporarily, but over time, it's going to spike up in value after you've improved the unit and you've now got a new tenant in there who's paying rent at a much higher rate. So you might be giving up rent at $1,500 a month to go do a rehab. So then later you're collecting $2,000 a month. And really what you're doing is looking at that sweet spot of, I've got a lot of units down right now because I've kicked a lot of people out. I'm going out, I'm getting maybe a broker price opinion. I was having lunch with somebody from Greystone yesterday, a broker, and we were talking about how this would work. I want to make this strategy mainstream because it adds so much value to people. And once people start to get the concept, this is another way that we can really leverage our retirement accounts and pay a lot less taxes, because overall taxes, I think, are going to be going up. And so investing a little bit and understanding how this works is going to save you a lot of money, wealth in the long run. And this kind of a strategy in the long run can really translate to 6, 7, or 8 figures of wealth over your lifetime. It really is amazing.
What if somebody invested with a account that's already tax-free, for example, and so the strategy of taking the valuation up and down, they're telling me, well, I don't pay taxes anyway on that amount, but I'm just disappointed because the FMV is not what I expected.
So you're just talking about the fair market value being dropped. To me, the fair market value is rarely used for tax purposes. I'm happy to discuss when it is, but it's a unique situation where it actually applies. So the fair market value is really, it's almost like your property tax rolls. So if you think of like the value of your property tax rolls on your house, you probably want them as low as possible so you're paying the least amount of tax as possible. The fair market value on the apartment complex, sometimes it's good, especially if you're doing a rollover, to have it rolled over a discount. It has no effect on what it's actually sold for later, because you will, when you go to sell it, will try and get the highest fair market value at that time when you're trying to sell it. But along the way, you're not trying to get this high fair market value to the property tax authorities, because you don't want to pay higher property taxes. So you only want to pop that fair market value when you need it for the sales price.
I see exactly what you're saying now. So we could just get a BOV. Anyway, just thinking
Yep.
as far as like we obviously protest our taxes every year, but this is an additional strategy.
Yes.
So we have two questions. I'm going to shoot them out there if it's okay.
Sure.
One is I have funds in a 401k at Fidelity that I rolled over to an IRA at Solo 401k company and started investing passively in real estate. Do you recommend doing investments from a 401k instead of an IRA? What are the pros and cons?
Yes, definitely recommend the 401k over the IRA. I'll speak to that in just a second. I will recommend my preferred provider. I don't make any money from these people, but I will just share it with you guys. It's solo401k.com, the neighbors group. It's like $400 a year to set up, $400 setup, $100 a year there after that. And they've got a great help queue, and they'll actually respond to your questions. They're a great company, and they'll talk you through how to do this. Questions on IRA versus solo 401k. I'm going to bring up the slide that I covered briefly before on the differences between the two and why they matter so much. So this is back to, I'll just, I don't know if that question came in before or after I spoke to this, but the main reasons with an IRA, you've got unrelated debt financed income, meaning you should be, if you invest in an apartment complex where there's debt, you should be filing a 990T tax return and paying taxes on it. And the IRS has recently, in the last few years, added a checkbox on the K1 for the tax preparer to check the fact that you're investing through a retirement account. And if the IRS sees that you're investing through a retirement account, but not filing a tax return for it when they would expect it, they've now got the information to go after this. They just haven't had the budget to really pursue this accurately. And if what Congress wants to do happens, they increase the IRS budget by 3 times, this could be really significant. You can avoid all of that by simply using a 401k instead. And there's some other benefits. I talk about inherited accounts. Like if you inherit an IRA account, like grandma has a retirement account, if you can even set her up on some sort of a solo 401k, then you can, I know some clients who've actually gone out, helped grandma get on a 401k, and when they pass, that inherited account can actually become a Roth IRA in time. You can't do that with IRA accounts. And also, if you make a mistake, you do a prohibited transaction, IRAs are going to basically die if the IRS catches you. With the 401k, it's a slap on the wrist.
I think I got a secondary question from that one. Since my funds are already transferred from the 401k to the IRA, can I move IRA funds back to the 401k?
Yes, you can. You can. You just can't do Roth IRA to Roth 401k.
Okay. I got another question for you. Are you familiar with borrowing funds outside of your self-directed IRA to complement the funds inside your self-directed IRA in order to complete an acquisition and rehab with the goal of selling it and returning those funds back to the self-directed IRA? My issue is that I have an ESA for my kids, and I'm trying to grow that as quickly as possible by pooling it with other funds on a flip.
So I know you can pull like $50,000 from a 401k, and it is doable. I know people who will use it, but you're only supposed to get 1 loan per year. It's not a super flexible strategy. So for me, I see it more as an emergency plan, but there's some that don't mind seeing it more as an investment plan. If I were you, I would rather invest my ESA in like a great apartment deal and make that the direct investment instead of borrowing from it. The fact that you're borrowing it from it leads me to believe that you don't have a self-directed plan. And I'd rather you go the self-directed plan so you can be more directed in your investments. And if you really want a plan to take off, that's where a rollover business startup, where you can actually have your company owned by a 401k. So this might work great for somebody who has a business with multiple service lines. So if I were an author or a speaker or a consultant, I could go out and start a Rob's company, do a little consulting on the side, and all the profits would be owned by my retirement account in the end.
What is a Rob's account?
It's a C Corp owned by a retirement account. It's a special vehicle that allows you to own a business by a 401k. Most of the time, people think that I can't, if I were to do an active business on behalf of my retirement account, it would be a prohibited transaction. And most of the time it is, except this is a unique scenario where the employees are allowed to own the company. And in this case, like a pension fund, like if you were to invest, I think of, there's a great hiking store. Is it REI that's like employee owned? And so they could have their pension fund that actually own the company. Well, this is simply taking a really big strategy and applying it to just you. You're the only employee of the C corporation, and that's how it works.
Got a couple more questions. That's great. So if I already invested passively in a real estate deal from an IRA, what are my options now to avoid paying taxes on the IRA?
I would try and get it to a 401k as quickly as you can. I will say technically you're supposed to be paying taxes through the date that it's in your IRA. In practice, I'm not your tax advisor, but I will say what I've seen happen before is some syndicators will just go through and backdate the paperwork and say, hey, this transfer happened as of January 1st of this year, and they'll issue the K-1 for January 1st of this year, and thus nothing gets reported in your IRA for at least this year. I'm not recommending that because I can't do that as a CPA, but some might do it that way, and it'd be really to your advantage if it happened that way.
Okay, so say I invested $100,000 from my IRA in an apartment deal passively. Does the K-1 losses apply to an IRA account, since you're saying that I now need to file taxes on an IRA account?
Yes. So if you, let's say you had two deals, one that made $20,000, another one that lost $15,000, you would at least get to apply the losses between the two of them to net out.
Good questions, guys. It's nice when people are engaged. So those were some really good questions. So it's in the chat, by the way, the from Keith, the solo401k.com. If y'all are looking for a resource, there's one. And then if you guys have any more questions, you can feel free to pop them in the chat. We've got a couple more minutes here. Keith, if anyone is interested in working with you directly, and I like also that I don't know what level of client you have to do this, but you like to travel and things like that. How can our audience get a hold of you and schedule an appointment?
So just to be clear, I'm no longer in the tax preparation business. I sold that in 2016, and I love to help people, which is why I'm out here now. What I do now is I work with a small group of business owners and accredited investors and really help them set up their own family office, or how to make wealthy business set up their wealth business. And I connect people to great syndicators like Kaylee in a variety of different asset classes, from oil and gas to silver mine to we recently had a brand new battery that's likely going to revolutionize the industry, a startup, cryptocurrency. There's all sorts of stuff that comes through, but I help people with the framework and concepts, and then the tax strategy is part of that, but it's not an a la carte service.
Okay. That's awesome. I got a question on that. Do you know, or do you get involved with any startup investments that are, kind of vetted, not exactly right, but with like artificial intelligence startups?
I've seen some of those. I haven't invested in any of those yet. I tend to only invest in something when I've got a competitive advantage, or investing with somebody I know has a competitive advantage. And so like with cryptocurrency or anything, if I don't really understand it or don't feel like I've been able to vet somebody who does, I don't.
Yeah.
So I've seen some of those, and I just haven't been able to vet it and know that it's a great deal for me.
That is something that I'm working on, just putting it out there, y'all. Like, I would not invest in that right now because it's really volatile until next year. And so I'm going to try to be on the front of this because I'm constantly reading and nerding out on that. But that one industry, if you're looking at, lithium, if you're looking at a lot of things that are available out there, even medical, that's something that's going to grow over 100% year over year, at least. In the next 10 years, it'll be an $8 trillion business at a minimum. So, I use AI all the time. Like, my calendar is AI. The way that I do on my blog posts, long form AI. It has a profile on me. All kinds of stuff. So just putting it out there. And if you ever get involved with that, I'd be curious to know like what your offices are doing.
Yeah, I'd love to powwow with you on that too. There's some other. You mentioned medical, so we had a deal presented. A good friend of mine is involved with this company, and there some medical researchers out in California had figured out how to extend the lives of mice with the drug. So it slowed aging and extended their life 2 to 4 years. And so they're going through another round of trials to start to get this stuff approved. Imagine the value of a drug if you could add 20 to 30 more years on your life.
So what does it do? Does it slow down the shortening of telomeres?
That I know it had to do with the slowing of tissue aging throughout your body, and because typically as you go on in life, your tissue just breaks down, and they had found ways to increase that life so it didn't break down like it normally would.
I have a biomedical science nutrition degree, kind of. So I was just curious. Gotten a couple more questions, if it's okay to kind of revert back to a couple more before we end our session in 4 minutes. So Sal has a question. If I have a solo 401k and a separate C Corp, can the C Corp borrow money similar to a loan from the bank from the solo 401k? An amortization schedule can be created and quarterly payback to the solo 401k by the C Corp will be done.
I don't think so. I think that'll be seen as a prohibited transaction unless it's under the umbrella of a Rob setup.
Rob's. Okay. I'm going to follow up on
Rollover business startup.
that. Thanks. Taking some notes. Okay. So a Rob's would be, I guess, a good thing to look at there. Another one, small clarification. If I think you kind of answered this, if I've already invested in a deal about 6 months ago, so it's been 6 months, half a year, from my IRA account, and now that I heard that I want to route them through a 401k, now I heard that I can route them through a 401k. Is that correct? How exactly do I do that? Is it just engaging the new 401k company and then you'd see if your custodian could backdate them? Is that right?
Yes, and do the rollover, and you'd also need to get permission from the syndicator, roll it over. I don't know of anybody who wouldn't want that and I don't think I'd ever use the words backdate with the custodian because they're going to be really careful. But sometimes the paperwork just happens to fall that way. So with the K1 and the syndicator's accountant might just treat it from day one that way.
Okay. How can we find out more about the Robs you mentioned to avoid a prohibited transaction?
So I'm going to refer you guys. Once again, I don't make anything from this. A good friend of mine that's also co-leads a mastermind with me for tax preparers, tax strategists. His name is John Heyer. IRAtaxdeductionlawyer.com. Some of you he does a almost weekly call, and he litigates this stuff. He lives and breathes tax strategy. I used to be one of two main tax guys for Quest IRA in Texas. When I left, John took over for that spot for me, and he's super sharp.
I think
taxreductionlawyer.com. I'm going to spell it out.
Hire, taxreductionlawyer.com. So I think I heard his name used with all the new legislation with high net worth individual qualifications and tax law that's changing.
Yeah, he was at my client event last week in Colorado Springs. He's a good guy.
Very nice, John Heyer. And then I do want to recommend to everybody that's out there, I'm going to give you a way, because we got to end the webinar really quick here. I know there's probably more questions. You can follow up with me and I can follow up as well with Keith. But, I have a summit called Generational Wealth Summit. If you go to my website, that walks you through, okay, I have crap credit and I want to get all the way up to building a family office, that's basically getting you used to the process of saying, okay, this, then create your own wealth, then be your own bank, and then, like kind of the generalized process. And it's a one-day thing that you can get involved with. But I really recommend thinking about, if you're doing all of these types of investments, et cetera, thinking about setting up a family office. It doesn't take as much as I thought that it did. And especially if you're accredited, that's something that you have an option to do. So anyway, if you're not quite there, we've got other things available for you as well. So I'm going to stick in a quiz, if you guys are not on our list already, that will just qualify you for me and my sake. I think I just sent it to panelists. Hold on. Let me send it to everybody. So this will qualify y'all as either accredited or sophisticated as an investor. That will put you into our list for what's available in the future. If you're interested in deal flow, what you would qualify for is what you'll be notified for. And then got my email, and you have Keith's email. Mine's admin@theapartmentqueen.com if you have any questions for me, and I'm happy to do more connections, or if you have any other topics that we didn't cover here that you'd like to cover in the future, I'd be happy to set that up too. All right, everybody. We are right at time, 1 o'clock. Let me let y'all go, and thank you for your patience with the technical difficulties. I appreciate it.
Have a good one. Thank you all.
Yeah.